So you're thinking of investing? I'm Vince Scully, founder of Life Sherpa, and I'm here to explain everything you need to know and everything you need to do to become a successful investor. First, let's confirm you're ready to invest. Do you spend less than you earn every payday? Do you have an emergency stash of at least 3 months spending? Have you paid off all your debts aside from your car, mortgage and HECS? Do you have some cash you don't plan on spending in the next 3 years or so? And lastly, have you considered whether using your surplus to invest is a better option than paying off your home loan or topping up your super? If you haven't checked all these boxes, you might be better working on that first. Otherwise, you've just taken the first step on your investment journey, getting started. Investing is the process of putting your savings to work to create more assets or income, or a combination of both. And like most things in life, the first thing to do is to set a goal. And if you're aiming to accumulate a sum of money to achieve that goal, you've got 3 levers to pull. How much you're going to set aside, how long you'll leave it to grow, and what investment return you target. You can choose any 2 of these, which will fix the third. But of course, not all combinations are feasible. Meet Brian.
Hey.
He aims to accumulate $150,000 and can set aside $1,000 a month. If he can earn 4.5%, he could achieve this in 10 years. If he wants to do it a bit more quickly, he'll need a higher return. An 11% return would allow him to get there 2 years earlier. And 11% is about the highest feasible return over any reasonably long period. For example, over the past decade, a portfolio of the 200 biggest shares on the Australian Stock Exchange would have given you an 8.5% before tax return, US shares 16%, and Australian bonds 2.3%. If he wants to get there even sooner, he'll need to contribute more. And the same works in reverse, where you have a lump sum to invest and you want to work out how much income you can generate. Higher returns in shorter periods lead to higher income. Lower returns in longer periods lead to lower income. You can generally be pretty sure of the amount you can afford or are willing to invest, and you're likely to have a pretty good idea of when you'd like to achieve your goal. But what return should you aim for? This all comes down to what assets you invest in and how it makes you feel. This is what we call asset allocation, and it's the key to achieving your investment goals. In fact, asset allocation accounts for 90% of your expected return over time. And there are only 5 types of assets you can invest in. I call these the 5 Bs of investing. The first 3 Bs are bills, bonds, and bullion. These assets are more likely to generate lower but steadier returns, so we call them defensive assets. Bills are dollar bills or cash, mostly in the form of bank deposits. This provides liquidity and low but stable returns, but its value is slowly eroded by inflation. Bonds represent loans to governments and companies. Investors in bonds make a return from regular payments of interest known as the coupon and from changes to the value in the bond over time. When interest rates go down, bond prices rise. Conversely, when interest rates rise, bond prices fall. The third B is for bullion. It's shorthand for commodities, a broad class of assets that includes energy, agricultural goods, and precious metals, including gold and silver. Most of these provide great short-term opportunities for professional traders, but for most long-term investors, this really means gold. Gold's a great diversifier. It's a hedge against inflation and is a safe haven to which investors flee when times get tough. The next 2 Bs are bricks and businesses. They're both capable of delivering high returns over the long term, while this does vary significantly in the short term, so we call them growth assets. Bricks include real estate and infrastructure. Real estate typically includes offices, factories, warehouses, shopping malls, and hotels. These are generally held to generate rental income, which is more stable than ordinary business profits, and for capital gains from the growth in value over time. Infrastructure includes all those facilities necessary for modern societies to function, such as roads, railways, pipelines, utilities, and airports. Many of these operate monopolies in regulated markets, and so exhibit highly stable cash flows and returns for investors. Investors receive dividends from profits and capital growth from the increase in value of these facilities. Businesses mean shares, also known as equities or stocks. And shares are small portions of the ownership in businesses, which entitle the holder to share in the profits and growth of those businesses. Investors in shares receive dividends and capital gains from the growth in value of those shares. So how do you spread your cash among the 5 Bs? In order to aim for a higher return, you need to allocate more of your investment to growth assets, bricks and businesses, and less to defensive assets, bullion, bonds, and bills. The more you allocate to growth assets, the higher is your expected return. But it comes with greater variability and volatility. So you need to allocate enough to growth assets to deliver the return you need, and enough to defensive assets so you can sleep at night and avoid panic reactions when the market falls, which it will. If asset allocation is the gateway to better returns, then your behaviour is the key to getting those returns in your pocket. In the words of Benjamin Graham, author of The Intelligent Investor, the investor's chief problem, even his worst enemy, is likely to be himself. So your response to risk and your ability to bear it matter a lot. And we call this your risk profile. Your risk profile comes from a combination of innate psychological traits, experience and education. Your risk capacity is a function of your time horizon and the availability of a plan B. Risk profiles are usually labelled high growth, balanced and conservative in descending order of ability and willingness to accept and tolerate risk. These names do vary widely between fund managers, so double check the asset allocation before investing. At Life Sherpa, we use a risk profiler tool and our money personality test to assess your risk profile. We use this profile together with your investment horizon to first align you with an asset allocation and then to a portfolio that can deliver the returns you need at a level of risk that will allow you to stay the course and sleep soundly at night. Generally, the higher up the risk spectrum you profile, the greater the proportion of growth assets should be included in your portfolio. When it comes to time horizons, I generally use 4 buckets. Very short term, less than 3 years or so. Short term being 3 to 5 years. Medium term being 5 to 10 years. And long term, anything over 10 years. Your base risk profile corresponds to the appropriate allocation for a 5 to 10 year investment. So if you profile as a growth investor and are investing for 5 to 10 years, you should choose an asset allocation and portfolio that aligns to growth or 80% growth assets. If you're investing for a longer period, you'd increase this allocation and choose a high growth allocation of 90% growth assets. If you're investing for a shorter period, you'd reduce this allocation and choose a balanced allocation in a portfolio with 70% growth. So let's talk about constructing your portfolio. Building a portfolio is more than simply collecting a spread of shares, bonds or funds that aligns with an overall growth to defensive split. It requires an understanding of how the assets chosen interact with each other to craft a portfolio that rewards you for the level of risk you take, delivers value for the cost, and aligns with your objectives. Generally, we look to avoid individual stocks and bonds because of the added cost and risk. Instead, we seek low-cost diversification by choosing pooled investments, such as managed funds and ETFs. These are baskets of shares or bonds which may number in the hundreds or thousands, which can be bought in a single trade. Some funds are actively managed. This involves a process of selecting individual stocks or timing the market with a view to outperforming. This adds costs and can involve higher taxes, and there's a weight of evidence that it rarely adds more value than the cost it adds. The alternative is to use an algorithm or index to select the stocks to include. Generally, we choose index funds where an appropriate index exists and there are funds available. Where there is evidence that active management adds value, small companies for example, or an appropriate investable index does not exist, we will allocate to an active manager. Generally, we prefer to choose listed investments for convenience, but we'll also use unlisted funds if necessary. ETFs offer some potential tax benefits over managed funds, and so are our preferred investment. Our investment process starts with an overall growth to defensive split. We then allocate these between the 5 Bs. Within each of those categories, we look to diversify by geography and size and choose one or more funds to represent those allocations. We aim to maintain these allocations as closely as possible over time by rebalancing quarterly. We don't seek to time the market by varying these allocations. From time to time, we may replace funds where they close or no longer align with the initial promise, but we seek to avoid excessive trading. Ongoing management matters. The market will deliver the returns. My job as your advisor is to ensure that those returns end up in your pocket. Some of this work is administrative in nature, rebalancing, making sure dividends are reinvested, and new investment or withdrawals are processed. Some of it's technical in nature, such as managing taxes, adjusting for legal and regulatory changes, and replacing funds that no longer suit your portfolio. These functions can be readily automated, but the biggest impact comes from maintaining the quality and consistency of your decisions and ensuring that human behaviour doesn't get in the way. But this is where a human advisor really delivers. This often plays out when markets decline, and they will. The stock market will experience a fall of 5% or more every year, and more than 10% every couple of years. From time to time, it will even fall 30% or more. But it also plays out in booms when investors pile more and more money into the market as FOMO drives decisions. The steady hand of an experienced advisor will help you avoid these costly temptations.